Alright guys, welcome back to the channel. So today I wanted to do a real basic video because I think this tool is not used by enough investors or people trying to plan for their future. And I can show you ways that people make mistakes when doing this. But the rule is called the rule of 72. And essentially it is just a simple formula. You can even do it in your head as you're going, or you can do it out to kind of figure out how much you're going to make per year or how many years it's going to take to double your money. All right. So it also estimates, the impact of inflation and it does it by compounding. And I think when people do the math of how many years it'll take to grow their portfolio, they generally do it wrong. So let me go ahead and pull up the calculator here. All right. So the way to do this formula is super simple. You got the 72 here. That's why they call it rule of 72 divided by whatever you think your annual return rate will be. Now let me show you a quick example of how people don't get it right. So let's say you're in some magical investment that makes 25% a year. Now most people would say, well, Tony, that's going to take 4 years for it to turn into double. And that's wrong. That doesn't take into compounding into effect. So if we do 25, as you can see, it's 2.88 years. All right. That's much different than 4. All right, so you got to take into account the compounding, and it really changes the numbers up. Now, let's go look at some standard things that you might be into. So if you're like me and you like the NEOS funds, SPYI, it's got a 12.4% rate of return, distribution rate, whatever you want to call it. But basically, they pay around 12%. So if we go back to our calculator, all right, and we're going to go back and take this out. We're going to put 12% in. That means that our investment in that will double in 6 years just off the distribution. Now, obviously, if you have share price appreciation, that will change that number. Now, I do want to mention that this compounds different than, say, if you have a weekly pay or something. That's going to be a different compounding. But I think you can see here, okay, I buy a NEOS fund. If I'm reinvesting the 12%, I'm going to have double what I started with in 6 years. So that's one way to look at it. Another one we can look at, if we want to look at a little bit of a different, 17.75 distribution rate on TDAC by Tap Alpha. This is another one I invest in. So at 17.75%, let's go ahead and do that. 17. Boom. So you're looking at just over 4 years, 4.05 years. Now, that is a huge difference from the 12%. But most people look at this formula and they don't understand that if you're looking at a 17%, it isn't just 17% every year, it's 17% compounded. Now, let's go a little bit of a different route here. And let's go look at the annual return for the S&P 500. Now, in 2024, it did 25%. 2023, it did 26%. In 2022, it lost 18%. 2021, 28%. 2020, 18%. So it's all over the place. But if you look, most people agree that it does about a 10% a year. And then if you look at it, compounded, it's 11.2. But see here, adjusted for inflation, 7%. All right. So you can argue it's between 7 and 10, but let's go look at it as far as doing it in the calculator. So let's say it's 7. 10.2 years to double your money. Nice and simple. All right. Now, if we go back, divided by 10, 7.2 years for 10%. Now let me show you guys a different way to look at this. So this is a Soxal put I sold today. It's out basically 4 weeks in a day, all right? Now it's sold at the 50 strike price, all right? So for the month, I got $200. See right here, average credit, $2 per share, expiring 2/20. One contract. So essentially I made, because it's $50 is my strike price, I made 4%. All right, 200, 450. So 4% a month here. Now 4 times 12, 48, right? So if we go to our calculator and do our rule of 72, 48% a year, I will double my money in 1.5 years is what this is saying. Now, obviously, you're not going to get that kind of premium without being heavily aggressive. It's not really a good idea. But I'm just making the point of how to use this formula for simple math. The nice part here is as you're building your portfolio and you're looking for a rate of return and trying to see how fast it's going to grow when you're growing your portfolio. But this tool can also be very helpful if you're looking at how much your retirement accounts are going to grow between the number of years you have left. That's one of the things we use it for, because Missy in her Roth and traditional has been doing 24% a year. All right, so it's going to take 3 years for her investment in there to double. All right, so she knows that formulation. Now she can figure how many gaps of 3 years she has between now and the time she can draw from those retirement accounts. And that will help her figure out what we will have a safe withdrawal rate, because if she can repeat this 24% every single year between now and then, she knows that she can probably continue that into the future. Obviously, nothing is ever for sure in the stock market. You have good and bad years. But if she's getting, on $50,000 maybe, or $100,000 we could do it, she's getting $24,000 a year, and she repeats that over and over and over. By the time it's time to pull it, we know we can pull the $24,000 a year, and she'll repeat it every 3 years, doubling her account. So it'll continue to grow even after we're pulling that. It's just a different way to look at the math, and it's fast. That's my thing. It's fast, so I can look at, if I'm doing this exact contract, let's say every month, as my one that's really aggressive, because generally it'd be more like about 2% a month. So this is an aggressive contract just to skew those numbers. But I can get an average annual rate of return of 48% if I do this, as long as I don't get assigned somewhere and drag the numbers down a little bit. But then doing that, I can use my rule of 72 to show how much this will change my growth of my portfolio. So try it out. Let me know down in the comments below if you guys use this to kind of check and see where you're at and how you're doing, if you're going to double in the amount of time you want to. Everyone should have a number they're trying to work towards in their portfolio, or a yield they're trying to work towards to consistently live off of. For us in semi-early retirement, this actually has been an excellent tool to help us figure out where we are and where we're going. I mean, obviously nothing's for sure, and none of this obviously is financial advice. But this is a nice tool to help you construct your portfolio and look forward. And with that said, if you haven't already, I don't know why you wouldn't have, go down, hit subscribe, hit the notification bell so you can see all of our upcoming videos. Give us a like. Let me know down in the comments, have you used this before? Or what kind of returns are you getting a year that should be put into this number, so that we can figure out what you're going to be doubling, how often. And with that said, I'll see you in the next one.